Welcome to SCORE Cleveland webinar on using financial data to manage your business. Richard and Chris will introduce themselves and take you from here. Chris and Richard, you're on.
Ladies first.
Hi, I am Chris Anna Lazar. I've been working with SCORE for a little over 4 years. I owned a printing business for 19 years. I shut it down during COVID. And I am most comfortable working in the area of finance with businesses, but certainly can do strategic planning, marketing, and HR, all the basic business functioning. And that's it. Richard?
Hey, I'm Richard Brooks. I've been a SCORE mentor for a little bit over 6 years. And my background is hospitality. And I've worked in the hospitality industry, restaurants and hotels for about 40 years. But I'm a generalist, just like every other SCORE mentor. And we're looking forward to helping you. I'm going to do the introduction. First of all, to start out, if you have any questions along the way, please use the Q&A, not the chat. Dan will be monitoring the Q&A for us. And everyone will receive a copy of the slide presentation and a link to the actual presentation that we're going to make today, so that you'll have it for your own reference. Chris, the next slide, please. For those of you who haven't worked with SCORE before, just a very quick introduction to SCORE. We are a nonprofit organization that provides free mentoring and workshops to all of our clients. We're a national organization. We have over 10,000 volunteers. The website that you're seeing here is the Cleveland chapter website, but if you're attending from chapter or areas that are not covered by the Cleveland chapter, your local area has a chapter that you can also rely on. Chris? Okay. The Cleveland chapter has a great deal of resources available, but you'll notice here in the upper left-hand corner, there's a link there that says Find a Mentor. That's standard on all chapter websites, whether it's Cleveland or anybody else. All you have to do is click on that. You can see the availability of local chapter volunteers, what they provide you. Just click on the one that you want, or you can just say, assign me a volunteer. It doesn't really matter. And we will get back to you shortly with a qualified volunteer to help you. Chris? Okay, we're going to be talking about financial basics today. And with that, I'm going to turn it over to Chris.
These beginning slides are yours, Richard. They're the financial statements.
You're right. I'm sorry.
Okay.
Today, what we're going to do is review some simplified financial statements to see what you can glean from them, and discuss some examples of how financial data can help business owners make decisions under changing conditions. And that's where Chris actually takes over. Okay, let's go into it. Okay, for those of you who attended last week, you'll remember that we talked about Puzzlemania, a fictitious puzzle manufacturing company. And this is a very, very brief example of their cash flow statement. Cash flow statement, and we touched on it very briefly last week, is one of the two really important financial statements that you need to become familiar with. And I'm gonna, this is for one full year of Puzzlemania, but you can draw this every month from whatever financial system you are using, or you can actually create it if you're just using an Excel or a Google Sheets model. It's very easy to create this. And in this case, you start out with a beginning cash balance. And in the example that we're using here for Puzzle Mania, they start out with $5,000. During the month of January, they took in $40,100 or $312, and they spent $21,070. So at the end of the month, they had $24,242 in the bank. And notice that $24,242 becomes the opening balance for February. During that month, they had $30,938 in sales and only $20,323 in sales. So their cash balance increased from $24,242 to $34,857. And that's the opening balance for March. In March, they had a good month as well, and they ended up with $43,861 in the bank at the end of the month. But notice what happens here in July. July is a slow season for them. They had 11,252 in sales, but they spent 27,837. So they went from 58,936 in cash balance to only 42,349. And then look what happens in August. 42,349 opening balance, 10,313 in sales, 37,183 in expenses, and they're down to 15,479. In September, it becomes even more critical. They opened with 15,479. They took in revenue 21,562, but they spent 36,807, leaving them with only $234 in the bank to cover all their expenses. Basically, they had no money to cover all their expenses at the end of September. So, a couple questions. Is their business seasonal? Well, it looks like it, because in January, February, and March, they did very well. As a matter of fact, all the way through June, they were increasing their cash sales. But in July, August, and September, their sales really went down, but their expenses went up. Now, there's probably a good reason for that. And the good reason could be is that they were getting ready for the holiday season when they sell a lot of puzzles. And so they're buying the raw materials to create their puzzles. The paper for the actual puzzle itself, the print ink, the packaging, everything that they need in July, August, and September to have an inventory ready to go for October. And you can see what happens in October. In October, they had 39,375 in sales and only 33,152. So their cash in expenses, so their cash position improved considerably. So it is a seasonal business, and one of the reasons why the cash flow statement is so important to you is it's going to help you manage your cash, which is really critical. Another question, what are the lean months? Well, they're July, August, and September, because we can see the cash balance going down. And how might the owner deal with those lean months? And that would be a question for them, but an example of how they might do it is perhaps stretch out their purchases for the holiday season into June, or maybe even May, because their inventory is not perishable. So this will give them an opportunity to actually stretch out their payments to make sure that they have sufficient cash and not run into that issue in September where they only have $234 in the bank. If they have one expense that they hadn't planned on, they're going to have to draw money in the form of either use a credit card or get a loan from the bank or something else to help them get through that month. Chris? Okay, and income statements. This is the other really important statement. And again, this is very simplified, but it gives you a good idea of what's going on. Now, in this case, instead of giving you a 1-year income statement, and you can draw these every month, you don't have to wait till year end or the end of 3 years. You should draw them every month. We showed you a 3-year analysis, and you'll see why. Puzzlemania produces 3 different kinds of puzzles: 200-piece puzzles, 1,000-piece puzzles, and 2,000-piece puzzles. And if you notice that they've had pretty good sales on all of them. In their first year, 2020, they had a total of $360,000 in revenue. And then their variable expenses, if you remember what we defined as variable expenses last week, and those are expenses that go directly against the production of those puzzles. So, for example, they would be the material needed for the puzzles. They would be the direct labor in manufacturing those puzzles. Those would be 2 examples of their variable expenses. So you'll notice here in 2020 that the 200-piece puzzles amounted to 31% of sales. The 1,000-piece puzzles amounted to 35% of sales. And the 2,000-piece puzzles amounted to 33% of sales. Their variable expenses, the 200-piece puzzles, $47,850, which was 27% of sales. The 1,000-piece puzzles, $62,200, or 35% of sales. And the 2,000-piece puzzles, $66,350, 38% of sales. Excuse me. For a grand total in the variable expenses of $176,400. The gross margin, which is $360,000 less $176,400, or $183,600, is 49% of sales. And we discussed that last week. This is a direct example of that. Their fixed expenses, the fixed expenses would be things like utilities, insurance, fixed salaries, not the salary, not the wages of the hourly employees, but the fixed salaries of people, for example, like the owner of the company or the marketing manager of the company or somebody like that that's on an actual salary and it doesn't change month to month. Those fixed expenses were $108,840, or 30% of sales. So their profit is $74,760, 21% of sales. And we discussed some of this last week. One of the reasons why you always want to include percentages in this is because if the numbers change, it tells you one thing, but if the percentages of sales change, it tells you something else, especially if the sales of one of your products goes down. It will be reflected not only in dollar amounts, but in percentages, which is really important to you. Same thing with variable expenses. If for some reason, for example, the tariffs kick in and the cost of your raw materials goes up 30% or 50% or 100%, whatever it happens to be, it's going to be reflected not only in the dollar amount, but in the percentages. And so watching those percentages as well as the actual dollar amounts is really important. So now let's look at, ask some questions about this income statement. How does it differ from the cash flow statement? Well, number one, it differs because it's not showing you a cash balance. It's showing you whether you made a profit or a loss. It's focused on profit or loss. It's not focused on your cash balance. Number two, did the company make a profit in the first year? Well, yes, they made a profit of $74,760, which represented 21% of sales. What product brought in the most revenue in the first year? Well, that would be the 1,000-piece puzzle. Okay. And then what product was most profitable? Well, there are ways of looking at this. You could say the 200-piece puzzle was 20 only had a 27% cost and variable cost against the 31% revenue. That's one way of looking at it. Another way of looking at it is to say, what is the actual profitability of each one of those? So you would do an analysis against taking out the variable expense for each one against the revenue for each one to determine which one was most profitable. And the reason why you're doing that is everything below the total variable expense line is a fixed expense. Okay, so it doesn't matter how profitable each line is in that respect because you've still got to cover your fixed expenses. Next. You'll also remember from last week that we had the sample of a service industry, Lulu's Beauty Salon. So let's look at Lulu's here and see how it differs from Puzzlemania. In January, Lulu also started with $5,000 in the bank. Her salon brought in $55,000 and she paid out $40,682. And keep in mind, just like in Puzzlemania, the cash out includes salaries and materials and everything else that's necessary to run Lulu's beauty salon. So at the end of January, she had $19,318 in her checking account. You notice in February, she opens up with $19,318. She had $56,500 in cash sales, $41,781 in expenses, and she had $34,037 in the bank. I want to move now to, if you look to the right side of Lulu's cash flow statement, in December, she had to open December, she had $116,621 in the bank, $69,000 in sales, $56,075 in expenses, $129,546 in the bank. Okay, so let's look at what we have moving through here. Okay, first question: any significant seasonal variation? Well, for Lulu, not really. Her sales go down a little bit in August and a little bit in July, but it's not significant. She's still making a profit each one of those months, whereas with Puzzlemania, in July, August, and September, they were not making a profit, and the reason why was they were building up their inventory to handle the holiday season. Okay, and does Lulu need this big of a cash reserve? Well, having this large of a cash reserve really is counterproductive. And there are a couple things Lulu could be doing. For example, She could have these in a certificate of deposit, which would actually earn her more than just keeping it in her checking account. So she could easily take $100,000 and put it into something that's going to give her a higher rate of interest. She might also consider taking some of this money and upgrading her beauty salon. One of the examples that we looked at last week with Lulu was also, should she consider opening another salon and having 2 salons in operation? So that would be another thing to consider. There are a lot of things to do to consider when you have more than sufficient cash reserve to keep your business going. And that's the most important thing. Have a cash reserve that is sufficient to keep your business going. And anything above that, you should consider putting into a safe investment like a CD or something like that. Chris? Okay, here's Lulu's profit and loss. And you know, the same focus that we talked about with Puzzle Mania. Shampoo for 2020 was $120,000 in sales, and that was 18% of sales. Her color treatments, 318,800, 48% of sales. And other services that she provided, 230,000, 34% of sales. Lulu had a total of $668,800 in total revenue for 2020. Her shampoo, $99,750, 25% of sales. Color treatment, the material for that, $167,700, 42% of sales. And other costs, other variable costs, $133,800, 33% of sales. Her total variable costs, $401,250. Her gross margin, $267,550. And look at her fixed expenses, $142,452. And she had a 19% profit margin, $125,098. Okay, so again, looking at this, what service brings in the most revenue? Well, that's her coloring. What service brings it costs the least to provide? What you would do then is take the for shampoo, for example, the 120,000 and subtract out the 99,000 750. Okay, and that would tell you the profit margin on shampoo. You would do the same thing with color, and you would do the same thing with the other. In this case, the service that costs the least to provide is the shampoo, but it also has the lowest revenue and the lowest profit margin. So what do the percentages tell you? The percentages will tell you where you are as far as profitability from a percentage point of view. So, for example, in the case of shampoo, it's only 25% of sales, the variable expense. But since the actual sales amount is 18%, that's why you have the lowest profit margin. So you would need to look at each one of these in detail. And then how would you increase profit? There are all kinds of ways of doing this. One would be adding on more product lines at a lower cost, lowering your variable expenses. So, for example, maybe one of the other services that Lulu is providing is a mani-pedi service. And in that particular case, maybe finding lower cost materials might help you with that. So that's just one example. Chris? Okay, so far we've talked about normal operation and how they should work for you. Now, let's look into what could go differently, better or worse, in some examples and how business owners might respond to them. Think about how you might use your financial data to adapt to these conditions. And at this point, I'm going to turn it over to Chris.
Okay, great. Thank you, Richard. So we talked about a lot of numbers last week. We looked at fixed and variable expenses so that we could figure out profit margin. We talked about break-even analysis. Now that you've gotten used to some of what your numbers look like and how to use this to evaluate, we're going to look at a couple situations and see how can we use our financial data to help us make decisions. So Richard mentioned that Lulu's made over $120,000 was left in her checking account. She started out with $5,000 and she had a lot of money in her checking account. So one of the things that Lulu's thinking about, she has this extra money. Should she open another location? She's been doing really well for 6 years. She's stable. She's got good revenue. She's got a good team behind her. So let's look at some of the numbers and let this help us make a decision if she should have another salon. So just to review from last week, we saw that her fixed expenses are a little over $11,000 a month. Her variable expenses are 60%, and she's maintaining roughly about a 20% profit margin. Very healthy. Every month she has roughly a little over $10,000 left over, which makes sense that she had $120,000 in her checking account that she didn't take this money out till the end of the year. So one of the things we didn't account for was Lulu's time. As an owner, a lot of times owners just take what's left over at the end. They don't necessarily take a regular salary. They don't know some months are leaner, some months are fatter. They take what they can when they need it. But we really want to evaluate what is the profitability going to look like with another person. So right now with Lulu running her main shop that she has 20% revenue, but we also know that Lulu works about 55 hours a week. It's not all at the salon. Sometimes she's home, paying bills online, scheduling things. She works a lot of hours. And so if she were to replace herself at the second salon, she figures she'd probably need to pay a manager about $35 an hour to do all of the people management, materials, all of the bills, all of the things that she does would require about $35 an hour, 55 hours a week. So that cost per month comes out to over $8,000. It's $8,278, which is another 15% looking at her revenue. That's a lot. So how does this look when we look at our profit margin? If we subtract, if she's bringing in $55,728 on a given month, and her expenses are $53,000, her profit left over is $2,593. That's a 5% profit margin. Oh, so then we want to ask ourselves, for an extra let's just say $2,600 a month, it's good money. I'm not saying that's not good money, but the liability, the stress, the overhead, the level of responsibility, she now has another facility. If something happens to that other manager, who's going to fill in? Lulu. So she's really kind of spreading herself thin at that point. And, maybe she can work a little bit extra. Again, this is it. A lot of this is kind of guessing. Maybe she can pay someone 40 hours a week and fill in some of the extra work. She's willing to work 60 hours a week, and maybe she can consolidate ordering for the two stores and make it more time efficient. Maybe paying bills, she can make it more time efficient. So there's things to wiggle with and figure out. But at the end of the day, is it worth it for her to have a whole nother facility to end up making the equivalent of maybe 30 some $1,000s extra for the year for all of the responsibility of having another salon? So, okay, that is Lulu's. We're going to also look at a situation that a lot of retailers find themselves in, and that is, should I offer discounts and coupons? It's a really good question. Sometimes there's very compelling reasons to do it, and sometimes it's just not a good idea. And we're going to look at what ends up as the bottom line, what's left money in your pocket, and when do you make the decision to do it, and when maybe you shouldn't do it. So we're going to look at an example, sticking with the Lulu salon, that she sells hair products. One bottle of, let's say, shampoo or conditioner is $10 wholesale, and she sells it for $20 in her store. That is standard markup called Keystone markup, and a lot of retail is a standard 50/50 Keystone markup. The retail is, it's half the cost of the retail is the wholesale price. So profit-wise, she's selling a bottle of shampoo for $20. She subtracts her cost to buy that bottle, which is $10, and that leaves her a gross profit of $10 per bottle. If she sells $100 bottles at $20 a bottle, she's bringing in $2,000 in sales. If she's looking at her profit, she has 100 bottles and she's profiting $10 a bottle. Half of that sales is her gross profit. So she's has a gross profit of $1,000 off of those 100 bottles. If we divide $1,000 into her sales of $2,000, we see she has a 50% gross profit margin. Now that's called a gross profit margin because it only accounts for her variable expenses. It doesn't take into account her fixed expenses, rent, utilities, all the other things. So that's why we're calling that gross profit margin. So let's say this looks familiar probably to some of you. We're going to offer 20% off. She's now going to sell her $20 bottle at 20% off. You subtract $4, that's the 20%, and she's now selling a bottle of shampoo for $16. Her cost did not change. Her cost is still the same, $10. So now instead of gross profit margin of $10 a bottle, we have to subtract the $10 of the cost of the bottle. We also have to subtract $4 for the coupon that we're giving people, the 20% off. So now her gross profit is almost half. It went down from $10 a bottle to $6 a bottle. It's funny because 20% doesn't sound like that much, but the way it hits the bottom line profitability is pretty intense. So all of a sudden, selling the same 100 bottles at $16 a bottle brings in $1,600 of sales. If we multiply the profit of $6 times 100 bottles, we're looking at $600 of profit. And 600 divided by 1600 in sales gives us a gross profit margin of 37.5%. So that is substantially lower than what she was making profit wise. Of course, you expect your profit to go down if you're giving a coupon, but that's a significant jump down. So, how do we make that profit back? Maybe we still want to maintain, we don't want to stop making the $1,000 a month. If we sell, just to recap, 100 bottles at $10 profit, we have $1,000. If we sell 100 bottles at $16, which we know is $6 profit, we're down to $600. So what we want is the $1,000 of profit. So if we divide $1,000 of profit by $6 per bottle, we see now that we have to sell 167 bottles to make up for that, what seems like a pretty small 20% off coupon. So we would need to sell 167 bottles with a 20% off coupon to make the same profit as selling 100 bottles with no coupon. So, wow, while this seems like, why would we do that? That's so much more. The downside is you have to have your money tied up. You have to have a lot more inventory to be able to sell the $167. So you've got more money, more capital investment in your inventory. You have more work, you have more transaction fees, you have more everything. Your costs and management and time and everything is caught up in it. But there are legitimately times where you want to offer this kind of coupon and it's strategic. And you say to yourself, maybe I'm going to make this up in volume. One situation is maybe you have a manufacturer who's offering a discount at any given time, and you can pass that discount on. So, yes, you do have to sell more bottles, but your percentage of profit maintains the same, and you don't lose the profit alone while you're paying the same price. Another possibility is that you have a new product and the only way to get it going, you're not going to offer a coupon all the time, but you think I'm going to have this introductory thing. I really believe in this product line and I really want to incentivize people to give it a try. And I'm willing to make less money on the front end because I believe in this product so much. I think they're going to come back and buy more. So I'm going to not make as much money on the first bottle, but then I'll make it up down the road because they're going to just love this. Another possibility is you over ordered and you have a glut of something and you don't want your inventory to get old and stale and you really need to move it out. So you offer a discount. Also, maybe you find yourself in a cash poor situation. Your cash flow is not healthy at any given time for whatever reason, and you really want to generate cash. You've got a lot of inventory, and you say, I'm willing to make less money right now because I'm low on cash. I need to generate some revenue, and I'm willing to do this. So there are lots of reasons to offer a discount, but they should be strategic. They should be based on data that you've collected and reasons that you have. You understand the impact to your bottom line and you're making eyes wide open. You're making a decision to sell things at less profit. Like I said, there's many more reasons. I just listed off some reasons, but there's many other reasons additionally. So, okay, that is offering a coupon. We're going to evaluate the same kind of situation, but we're going to look at how do I know if advertising is worth the money? So this is a big question. Lots of people ask it. There's different ways to evaluate advertising. Sometimes it's hard to collect the data cleanly, but let's assume you offer some ad. You basically want to the greatest degree possible, track the revenue that's coming in from that ad. Otherwise, you're not going to know how much was because of the ad and how much was just normal sales. So to the degree that you can have some connection or understanding of where did you hear about this and is it new clients, where did this come from, tracking it is important. But okay, we're going to look at a very specific example. Puzzle Mania, we know that they sell the most. Their hot and heavy season is during the winter holidays, but they were considering maybe during their slower months that they may want to put an ad in, generate some interest, and generate some sales. So their average monthly revenue, as we learned about last week, is $30,000 a month, and they have a 21% profit margin. So they are contemplating putting an ad out that costs $2,200. And if they did this, they can guesstimate that their sales would increase by roughly $14,000. Now, that $14,000 is not cash money in their bank account because they have all their expenses. So this is where it's really important to know their profit margin is 21%. So what they're actually bringing in profit-wise from that $14,000, you multiply 14,000 times 0.21 because that's the actual benefit to the company. That's what their added profit is from those $14,000 of sales. So that comes to $2,940. If we subtract the cost of the ad, which was $2,200, we see the profit after the ad is $740. If we divide 740 into $14,000, the profit margin, what's left in their pockets to spend, to give raises, to have bonuses, it's a very small 5% profit margin, and they will have depleted their inventory by 700 puzzles. They're $20 a puzzle, so they had to sell 700 puzzles. So imagine the time, energy, effort, and work that went into selling 700 puzzles to profit $740. Now, again, this might look like this is a silly thing. No one would ever spend $2,200 to sell through 700 puzzles to profit $740. But there's lots of reasons why you might do this, similar to Lulu's. Maybe you have way too much inventory. You over prepared for holiday season, and come January, you have way too much inventory on your hands and you don't want to sit on all that. So this would be a great time to advertise, get through that inventory. You might even have to sell it at a sale in January, and that would additionally cut in to your profits, but at least you're getting that cash back that will be part of your working capital, and you'll have that $14,000. Again, it's not all profit, but you'll have cash back in. You'll burn through some of your overstock items. And again, there's a variety of reasons. Maybe you have a new puzzle process, or you have a new artist that you're representing, a new line of puzzles, a different level of complication that you want people to know about and try. And you think after they buy the first puzzle, they're going to love it and then come back for more. So again, there are reasons to do it, as long as you understand what is the actual bottom line impact to my profits and my business when you're making these decisions. So we're going to look at the exact same thing. The screen barely changed. Instead of the ad costing $2,200, now it's $2,500. So if we look at all the same numbers, we have to sell 700 puzzles. It's $14,000 of new sales, but now we're subtracting $2,500. We're down to $440 of profit after our ad expense. $440 on $14,000 of sales is a 3% profit margin. So again, if you look at this, there's also the calculation, the ROI is what's referred to as your return on your investment. You basically take your gains minus your investment costs divided by your investment costs. And if you're comparing one ad and potential revenue with another ad and potential revenue, you can start to determine when these things are worth it for your business and under what circumstances, and when they're not worth it for your business. So data is very powerful. The more information you collect and keep, the better information you're going to be able to make moving forward. And it's fine to make mistakes and take some risks. They should be educated risks. You should want to be able to guesstimate how much revenue would I need just to break even on this ad. That's another thing you could calculate. And what is the impact, and how do I see this ad working for me in the future beyond just this initial cost of this ad? So we are going to go back to Richard. He has additional strategies to help improve profitability.
Thanks, Chris. Let's talk about some additional strategies. Notice here the first one says fire your worst customers. It's a pretty a radical approach, but it works. For example, you have customers who expect the same discounts as you have small customers who expect the same discounts as your largest customers, but they don't buy much from you. You have customers who pay their bills in 60 and 90 days instead of your usual terms, which should be, cash upon delivery or cash within 10 days or 15 days. And they're using you as a credit card. Don't allow your customers to use you as a credit card. You have customers who dispute many charges. They buy a lot of items or a lot of services from you. And then they come back and say, well, this isn't what I expected, or that didn't work out, or whatever it happens to be. And I want a discount, or I want to return this item. And like the last bullet point, they buy a lot from you, and then they return a large portion of their products because they don't sell them. These are not good customers. And to give you an example, in the hotel business, we would have companies and groups come in the door and say, we will give you a lot of business, and we would quantify that business with them. For example, a group might, or pardon me, a company might come in and say, we will give you 100 room nights. In other words, a guest room night is one night stay. So we'll give you 100 night stay in January and February, March of next year. But if we do that, we want a 10% or a 20% discount. So we would use the formula that Chris showed you previously on couponing. That's basically discounting. And we would determine whether the increase in sales from the 300 room nights would benefit the hotel. And so we would then track it. And if the company did fill 300 room nights in 3 months, we would just keep it going because it benefited us. If, on the other hand, they only did 200 room nights over the 3-month period, we would go back to them and say, we're not going to give you that deep discount anymore. We're either going to give you our standard corporate discount, which might be 5% or 10%, or we're not going to give you any discount at all. We don't ask for the money, retroactively, but it was an estimation on our part, and we would then go back and make adjustments as appropriate. In a sense, firing your worst customers is watching what they're doing and how much profitability they are actually bringing to your company, and then making a determination whether you want to give them all the benefits of your best customers. Next, Chris. Okay. Do you have customers who you would fire and why? It's important that you do an analysis periodically of these customers to find out, whether they are really considered your best customers. Next. And yeah, keep going. I think there's one more there. Okay. Expand your products and services. Build a defendable fort first. A lot of my clients want to go out and have ambitions well beyond just opening a business. A lot of them say, I want to open a restaurant, and then 2 years from now, I want to franchise the restaurant idea. Some of them say, I want to start a store of some kind, not necessarily a hospitality store. And, in 5 years from now, I want to have 10 stores that I'm going to own. Build a defendable fort first. And that term is actually a term that I got from one of my past employers, Nestle. Nestle starts out building a defendable fort on all their products. So what do they mean by a defendable fort? Well, what they mean is they start out slowly. And the best example I can use for that is Lean Cuisine. Nestle, when they brought out Lean Cuisine in the mid 1970s, they did not start out with a national campaign. What they did is they went into 3 or 4 test cities and tested the product for 6 months. And they tested the product quality. They tested the acceptance by the customers in those test markets, and they tested the pricing of that product for 6 months. And then they went regional, and they did test markets beyond their initial test markets to all the regions of the United States, so Northeast and Mid-Atlantic and South and West Coast and Southwest and all these different areas. They had test markets identified. And then once they did that for like 3 or 4 months, and then once they saw what was going on, that they weren't going to have any regional issues with pricing or with distribution or what the customers were expecting from product quality, they went national. And that approach is what Nestle does with all their new products. They did the same thing with French bread pizza and all their other products. And for each product, they build a defendable fort. Well, that's really worked out well for them. That approach has worked out well for them. Today, Lean Cuisine has 50% of the diet market. And the quality is there, and the pricing is right. They actually charge slightly more than their competitors, but they've built up the brand loyalty. They're known for their high quality, and they are the preferred brand in the health conscious market. They built a defendable fort for Lean Cuisine, and they do that for all their products, something that you should consider as well. Test your idea with your customers. And that's exactly what Nestle did with Lean Cuisine and their other products. They tested the idea with their potential customers. And be careful on testing. Don't just say to a customer, I'm thinking about adding this new product or this new product line. Would you be interested? Because in most cases, customers are going to say, oh, yeah, that sounds really good. I'll buy that. Okay. Don't do that. Buy a small amount of the product, or propose your service to a client and see if they'll buy it, and test it with them. Actually do the service. Tell the client, the customer, that you'll have the product in a week. and you'll have it available to them at that time, and you hope to see them come back and see if they actually buy it. Start out with a small quantity and build up from there. Minimize your investment until you know you have a market. That's exactly what I just mentioned to you. Do a competitive survey. Find out what your competitors, your direct competitors, are doing, what products or services they offer, and find out from your customers if there are products and services that you could add based on what your competitors are doing that will give you a competitive edge. And that's really important. It's important to think outside the box, but be cautious. It's really interesting that there's in the Cleveland area here, there is a hardware store that I go to, just a local, it's a franchise, it's an Ace hardware store, but it's not a big box store. And I go there because they have really good people who give me good advice on things like, what paint I should buy and other things. And when you go to the checkout line, it's really interesting because they have greeting cards in the checkout line. And I once asked the owner of that store, why did you do that? And he said somebody came in one time and suggested that we do greeting cards, and we tested the idea, and it made a lot of sense. And so we have a whole rack of greeting cards now. And he said, believe it or not, we sell a lot of greeting cards. And so that's really thinking outside the box, because you wouldn't think of that for a hardware store. But they do a lot of spur of the moment sales on greeting cards. Chris? Finally, what does thinking outside the box mean to you? Look at that. Think of things that you as a customer might want and be intrigued in finding with your business. And that would be an opportunity to test. Next. And how would you build a defendable fort for your business? And do you have a defendable fort already? Think of that seriously. Be careful wanting to expand too soon. You could easily lose control of the situation. It could cost you a lot of money. And if you're creating a business plan, one of the things that I advise with my clients is don't talk about phase 2 or phase 3 in a business plan when you're talking to a lender. They want to know how successful you're going to be in phase 1 to make sure that you can pay back their loan. Next, Chris. Okay, finally, for my portion, reduce fixed costs. If you're leasing space, talk to your landlord about reducing your lease. And maybe one of the lease costs, and maybe one of the approaches is you're at the end of a 3-year lease, and you say to the landlord, I'll sign for another 3 years, but I want to make sure that for at least the next year, the price increase cost, the lease increase cost for my lease, you're willing to forego that if I sign another 3-year lease. So instead of increasing my monthly lease cost by 5%, you'll keep it at what I'm paying this year. And for next year, if I sign for an additional 3 years. That's very helpful to the landlord, and it's helpful to you at the same time. Be sure you are taking all your tax credits you're entitled to, especially if you have a home business. Now, be careful about this. You need to talk to your accountant on it, because the government has certain restrictions that they look at if you're taking all kinds of deductions on your home business. But some costs are deductible. So be very careful on that, but be sure to take all the tax credits. A lot of people overlook tax credits that are available to them. For example, they don't track business mileage in their automobiles. And that is a legitimate deduction. As a matter of fact, for a client this morning before this session, I looked up what the US government allowance is. It's 70 cents a mile now. So that's a legitimate business deduction. You will need to have proper records on that. You can't just say I drove for the business 5,000 miles last year. You'll need to have records to show it. Who you visited and the distance from your office, those kinds of things. But it's well worth the bookkeeping to actually do that. Consider low-cost suppliers, but sometimes it may cost you more in the long run. So be careful of that. For example, in the restaurant industry, restaurant owners or maybe the chef, depending on who's in charge of purchases, will have 2 or 3 vegetable suppliers that they bid on regularly and see who has the best pricing. At the same time, they will also look to see the quality of the product that they get in when they do buy from these 2 or 3 different vegetable suppliers. And if vegetable supplier A, 3 heads of lettuce go bad very quickly in the case of lettuce that they buy, and in vegetable supplier B, they have a much lower waste factor. It may be worthwhile buying from vegetable supplier B because the overall cost, even though you may be paying a little bit more, the lower cost because there's a lower waste factor actually proves out to be better for your business. And then finally, consider bundling. And by that, you see this on TV all the time, home and auto, bundle and save. Well, you can do the same thing. For example, if you have your general liability from one company and your fire insurance from another company and your theft insurance from another company and your business interruption insurance from another company, put them all together and bid all the different companies and tell them you want one coverage with bundling on it, and see what happens. The same thing, add in your auto insurance. There are all kinds of ways of doing bundling, not only with insurance but with others as well, where you have an opportunity. So that would be another approach to reducing your fixed costs. What fixed costs are negotiable and when are they renewed? Track your fixed costs. For example, the lease. When is it due? You want to talk to your landlord probably 6 months in advance, definitely no less than 3 months in advance, because your landlord is going to want to know whether they have to put your space up for lease, and they don't want to do it any less than 3 months because they don't want that space to be vacant for long. You have more negotiating power if you do it well in advance with the landlord, because then they just take that off their books. They don't have to worry about having to hire an agent or put a sign out front, or whatever it happens to be, to keep that space occupied. And can you renegotiate fixed costs before they are renewed? Absolutely. Track when your fixed costs are due, and then work with your suppliers on reducing your fixed costs. Finally, how would you verify comparable value when researching lower cost suppliers? Test them. Very simple. Test, in the case of Puzzle Mania, one of the things that they could do is go for a lower cost paper supplier. But when they're printing their puzzles, if the cuts that they have to make in the puzzles so that they have pieces out of it. If those cuts aren't clean, or if the paper doesn't hold the ink properly, or whatever it happens to be, they end up turning into a larger, higher cost supplier because there are more and more product problems that they don't want to pass along to their customers. I use the example of the bad heads of lettuce as another example. So include all the costs and the error rate, the product problem rate in your total evaluation. Chris? Finally, let's look at a couple other scenarios here. What if Lulu encountered a large unexpected expense like flood damage and had to borrow from her credit line? Okay. That's going to have a significant impact on her cash flow. And that might be one reason why she wants to keep a higher balance of available cash. Maybe she's in a location where she had, when she took the space, she wasn't aware that her store was in a flood zone, or that the drains backed up during a bad flood or a bad rainstorm. And so that would be one example of a situation with Lulu. And so, once she learns that lesson, she wants to have a cash reserve available. And how might interest affect her cash flow? Well, if, for example, she borrowed $20,000 on a variable rate business loan, and the interest rates went from 6% to 8%, that's going to put a significant dent in her cash flow because she's going to be paying a higher interest rate every month. So if she borrowed that money on a credit card, it's really important because credit card rates right now for the best borrowers are around 19%. Are the borrowers with the lowest credit scores are around 29%. That's a big issue and something to watch because it has a direct effect on your cash flow and your profitability. Let's keep going. Chris,
Richard, I just want to say it's 1:07,
Yeah.
and maybe we want to see if people can stick around for a few more minutes. We went over a bit, answer some questions.
yeah, let's go to the questions. And
Okay,
uh,
excellent.
Dan, I saw there were two questions right at the beginning.
Okay, let me read those to you.
Yeah.
The first question from the beginning is from Lauren. I have some questions from your last webinar about finding the break-even point. Can you explain what this is and how it works?
So just to briefly summarize, you need to be able to calculate both your fixed and variable expenses so that you can calculate some percentage of profitability. Once you have your percentage of profitability and know your fixed and variable expenses, you can see how many units of a product or services, if it's a service. Now, the tricky part is the averaging. And so what you do is you use your history. More history is better. It'll give you a broader average. And then even within that, I like to look at maybe if you have a 6-month period, and I would break it into 2 3-month periods and say, does the data seem consistent? So it's doable for anyone to figure out, but it's definitely easier with a mentor. So if this is something that's out of your general scope of experience, I would say definitely get a mentor, and you want to figure out fixed and variable expenses, calculate profitability, and then you can find your break-even point. Your break-even point is so important because again, it tells you you're on track for the month, you're not on track for the month, and how do you set goals and where does your real levels of profitability that you want to attain come from? What level of sales do you need to make the money you'd like to make? So if you can go backwards, you can set goals, and that information is so valuable. And that is the information you also need to calculate giving product away with discounts, advertising, extra money that you may or may have. Like all of these are not shots in the dark. They can be educated decisions if you get this information. It's a great question.
And
Okay,
every
here's, go ahead.
just want to add, every SCORE volunteer is qualified to help you with that type of information. We don't charge for our services, as you know, so by all means, get a SCORE mentor. Just go to the website, click on, request a mentor, fill in a little bit of information about yourself and what your issues are, and we will assign a SCORE mentor to you very quickly.
Okay, here's probably your final question, given the hour. Can you mention, without any specific recommendation, some of the financial software packages that a small business might consider for generating and maintaining financial statements?
I don't know, Richard, you can fill in. I
Yeah.
know right out of the gate, Wave has, and I have a number of clients who use it. It's free. I find the chart of accounts a bit odd. They have like 10 different phone options, but they're missing like basic cost of good things. You can edit it, but again, you're going to need to know what you're doing. My best advice is to have an accountant set you up and then you just maintain it. Setting it up on your own can be a bit tricky. It depends. Each industry has its own standards that you will want to understand and follow. Everything is numbered. So I would suggest Wave is one. QuickBooks is expensive, but it's very, I think, user friendly. And then there's more involved accounting software that's probably beyond what most people would need. Anyone using point of sale systems also has embedded lots of data and information. It's not all of your information, but it's a good amount. So, Richard, any other
Yeah,
suggestions?
QuickBooks is probably the best known, but and Wave is a very low end for simple accounting issues. There's a product called FreshBooks for Macs only. There's a product called Xero, which is Xero. There are a lot of them out there, but Chris is right in the sense of work with your accountant. Your accountant can give you really good advice on which product they recommend because the products that they use in their accounting office are not what you would use in yours, but if at all possible, having a product that can just download directly from your system into their system versus having to provide paper reports and have them rekey all your information in is going to be a lot more efficient. In addition to that, each trade association, Chris mentioned chart of accounts, each trade association in the United States issues the chart of accounts for that business, for that industry that they serve. And that's public domain information. And if your accountant is not familiar with the chart of accounts for that business, they can go to the trade association and get it for you, and then help you build your chart of accounts for your business. And then you're set up properly.
Okay, Richard and Chris, thank you for a great presentation. Do you guys want to make any closing statements?
Get a SCORE mentor if you don't already.
Get a SCORE mentor.
All right. Just to remind everybody, go to score.org/Cleveland. If you just say SCORE, you're going to get Guardians baseball statistics. So you really have to say score.org. So go
Yeah.
Guardians. But or calves, your choice. But in any way, I want to thank everybody for attending, all 38 of you who stuck with us through thick and thin, and thank Chris and Richard for a great presentation. You will receive a link to the recording and the slides. Give us a few days to get that out to you, because we do have a contractor who does that for us, and they will get that out to you because you attended this session. Thank you and good afternoon.
Bye.